I'm an accountant, you want to pay less on taxes, so let's cut to the chase. I'm going to be going over 13 methods that I feel are the best and that almost everyone can use. I also promise all of these tips are legal, so you will not be prosecuted by the IRS, although don't go too crazy with the last one because that's when people get greedy and run into trouble. Two words you need to understand before going through these are tax deductions and tax credits. There is a very big difference. A tax deduction will reduce your taxable income. So if you're making $50K a year and you get a $10K tax deduction, that means you only have to pay taxes on $40K of your income. A tax credit, however, is a dollar for dollar deduction on the taxes you have to pay. So let's say you know your taxable income and at the end of the year you have to pay $10K in taxes, but you have a tax credit of $7,000. That means you only have to pay $3,000 in taxes. Tax credits are usually seen as the more valuable of the two, but tax deductions can lower your taxable income bracket. So taking advantage of as many deductions and credits as you can is not only a great way to get your money back dollar for dollar, but it's also a great way to lower your tax bracket so the IRS takes a lower percentage of your hard-earned money. And today I'll be giving examples of both tax deductions and credits, so I highly recommend using both of these to your advantage. And the first method I'm going to go over today on how to pay less taxes is to deduct any losses from your stocks. The S&P 500 is great and it's usually what I recommend, but what happens with those stocks that we decided to take a little risk on, and let's just say that the risk did not pay off? You can deduct the losses from your bad stock picks and lower the amount of tax you'd had to pay on stocks that you did make money on. So no, this does not impact your taxable income, but it does impact the taxes you pay on capital gains, and the less you can pay, the better. Also note you will only ever need to pay taxes on stocks that you sell or dividends, which is why I recommend investing long term in something like a Roth IRA so you can deduct everything at the end and pay no taxes. Method number 2, investing aside, let's say you gambled your money away and that 8-leg parlay didn't hit how you thought it would. You can also deduct your gambling losses away from your gambling winnings. So if you're losing money on sports betting, you can deduct how much you lost from how much you won and pay taxes on the difference. Method number 3 and 4 will be for any college students out there. The American Opportunity Credit can cut your tax liability by up to $2,500 if you're paying for the first 4 years of higher education for yourself, your spouse, or a dependent that you claim on your tax return. To qualify for this credit, the student has to be enrolled at least half-time and pursuing a degree or another educational credential at a college, university, or other eligible post-secondary educational institution. However, this might not apply to you if you're making more than $80K a year. And method number 4, the student loan interest deduction. So if you are paying off student loans, you can deduct up to $2,500 for interest that you pay. And for method number 5, we'll be going over donations. Now this isn't necessarily just cash donations. Those are the easiest to keep track of for sure, but let's say you donate clothing, food, furniture, lots of things, you can also get a tax deduction for this. Please keep in mind, for example, if you are donating clothes to Goodwill, you will need a receipt for this, or at the very least, you will need to make a list of what was donated. And there's lots of free services online that can calculate how much that donation was worth. Method number 6, and I probably should have mentioned this first, but adjust your W-4. If you are used to getting big tax refunds in the past, adjust your W-4 so less taxes are taken out of your paycheck and you're not needlessly living off of less than you deserve. The most obvious way to pay less taxes is to decrease your taxable income because the government can only force you to pay taxes on income that is, well, taxable. There are many ways to do this, and one of them is to contribute to a 401k. The IRS does not tax what you contribute to your 401k that comes directly from your paycheck, so you get to invest more money and you get to pay less taxes because of it. Now, what if I told you there was an account that lowers the amount of taxes you have to pay, lets you invest with pre-tax money, and lets you withdraw the same money without having to pay any taxes on it afterwards? Sounds a little too good to be true, right? Well, it's not. If you have not heard of this account before, then remember it now and learn as much as you can. It's called a health savings account, aka an HSA. Now, the next method, and you probably guessed it, is to contribute to your HSA. You only have to pay taxes on your taxable income. So by contributing to your HSA, this directly decreases your taxable income. And if you're not aware, an HSA is an option that you can select when going through your insurance plans. This can probably lead you down a rabbit hole of how to use insurance to lower your taxes, and that can be a whole video in itself. The rich use it to get richer. The next method is to see if you are eligible for an EITC, aka an Earned Income Tax Credit. This will vary based on your marital status and number of children, but if you made less than or close to less than $63K in 2023, this may apply for you. Please look into this because this can get you a credit, remember the very good one, of up to $7,400. This is an insane amount for a tax credit, so it really doesn't hurt to see if it applies for you. The next method is medical or dental expense write-offs. For taxes filed in 2024, you can deduct qualified medical expenses that exceed more than 7.5% of your adjusted gross income, your AGI. So for example, if your adjustable gross income is $40,000, the first $3,000 of your medical expenses, aka 7.5% of your AGI, could be deductible. So if you rang up $10K in medical expenses, $7,000 of that could be deductible. Method number 11 is a technicality and it's super overlooked, but it's as simple as timing your big expenses. If you have a big expense coming up that you know can be tax deductible, it does make a difference if this happens before or after New Year's, as any expenses that take place in 2024 will need to be claimed in the 2025 tax filings, not the 2024 ones that you're doing now. I'm going to combine the next two into one because they are children related, so if you do have children or maybe you plan to eventually down the line have children, pay attention. If you plan to or you are saving money for your children's college fund, unfortunately this cannot be deducted from a federal income tax, but you might be able to deduct this from your state income taxes if you're saving for your kid's college fund by contributing to a 529 plan. And arguably even more important for anyone in the US that does have children is the child tax credit. This can significantly reduce your tax burden. As of now, this child tax credit is worth $2,000 for every qualifying child. Keep in mind this is a credit, which is the very good one we talked about earlier, but you also have to know that you cannot be making more than $200K as an individual or $400K as a family. Now the final method I'll be going over today is by far the best way to save money on taxes, and I bet you're not doing it. Anyone with a tax professional accountant who knows the ins and outs of all the tax loopholes will always tell you one thing: don't file as an individual. You are going to receive the most amount of tax deductions, expenses, write-offs if you file as a business. Let me explain why. As an individual, you make money from your job, but before you receive that money, the government takes their portion, and then you can use whatever's left over after taxes to pay your bills, food, entertainment, and so on. As a business, you make money in the form of revenue. You use that money to buy things you need, and then after you've paid for all your expenses, you're taxed on the profits, which is basically any money you didn't spend. So for example, if a business spent more money on expenses than revenue that the business actually made, they technically don't even have to pay taxes. You do still need to file a tax return, but technically you don't have to pay taxes because you didn't make any money. This is why I highly recommend, if you don't have one already, start a new side hustle or a business. It is a great step into entrepreneurship and it'll save you money on taxes. Keep in mind you can deduct anything that is required for you to pursue this hustle. So if you have a home office or if you use the internet, maybe you just bought a camera and even drive to places for work, this can all be tax deductible. But please keep in mind, and this is where people get in trouble, it is tax deductible as a percentage of how much that service is used for your business. So for example, let's say you have internet, and 50% of the time, you're using that for personal use. The other 50% of the time, you're using it for your side business. You can only write off 50% of your internet bill as a business expense. Another example is if you have an office space in your home. If you have a 1,000 square foot home and a 200 square foot office that you use specifically for your business, you can deduct up to 20% of your mortgage, rent, utilities, and all of that good stuff for the percentage that it takes up of your entire home or apartment. So no, just because you're self-employed and work at home does not mean you can write off your entire mortgage. One more example, which is honestly my favorite. Let's say you're considering turning a work trip into a vacation. You can write off the travel expenses as a percentage of how much of your time was related to work versus vacation. This can help reduce the cost of airfares, hotels, all that good stuff that you would need for a work trip. To be completely honest, being self-employed or at least having a side hustle is the best way to take advantage of as many deductions and tax credits as possible. Your housing, utilities, healthcare expenses, travel expenses, there are just so many things you can write off to lower your taxable income. Anyone who really knows the tax loopholes knows you need a business to really make the most of them. If you have any questions about your personal tax scenario, feel free to leave that in the comments and I'm going to do my very best to help you out. I've got another book to get back to, so I'm going to head out, but you have a great day, week, and have fun filing your taxes and stay smart.